The US and EU just made a quiet trade move, but this might just shift gears for Indian auto giants. Now here's what went down. For weeks, Trump had been threatening tariffs as high as 50% on European goods. But after back and forth negotiations, both sides landed on a 15% tariff rate covering most EU exports to the US, including cars, chips and pharma. Now that's half of Trump's original threat and well below his final 30% warning if a deal wasn't struck by August 1st. So what changed? Before Trump's return, the US and the EU already shared one of the most balanced trade relationships, worth nearly $2 trillion a year. Where is this from? It seems US had a trade deficit in the past few years. According to USTR, US total goods trade with the European Union were an estimated $975.9 billion in 2024. US goods exports to the European Union in 2024 were $370.2 billion, up 0.7% from 2023. US goods imports from the European Union totaled $605.8 billion in 2024, up 5.1% from 2023. The US goods trade deficit with the European Union was $235.6 billion in 2024, and that's a 12.9% increase over 2023. Together, they make up 44% of the global economy. Now, tariffs were relatively low. The US charged 1.47% on EU goods and the EU charged 1.35% on American ones. But that balance was at risk, and neither side wanted a full-blown tariff war. As President of the European Commission, Ursula von der Leyen put it, the goal was to rebalance but enable trade, protecting jobs and prosperity on both sides of the Atlantic. Trump hailed the deal as a historic win for American workers and security, while EU leaders framed it as a pragmatic compromise in a changing global order. Now, the deal might not sound dramatic, but for global automakers, predictability is everything. Because when you know what the rules are, even if they are not perfect, you can plan better, price better, and protect your margins. So, why should you as an Indian investor care? Well, because some of India's biggest global-facing auto names are directly in the crosshairs of this very deal. Let's start with Tata Motors. Its luxury arm Jaguar Land Rover gets 33% of its global volume from the US and contributes a massive 70% of Tata Motors' revenue and 77% of its profit. JLR's largest Land Rover plant is in Slovakia, which manufactures two of its most high-volume SUVs, the Discovery and the Defender, both exported to the US. With a 15% tariff cap now in place instead of a potential 30 to 50% spike, this could soften the pressure on margins. Now take Samvardhana Motherson, one of the world's largest auto component suppliers. It earns about 20% of its revenue from the US, and 40% of that US revenue is linked to EU supply chains. With the threat of extreme tariffs now off the table, that's a direct plus for margins. JP Morgan had earlier warned of a 5 to 10% EPS hit if tariffs stayed elevated, and this deal helps cushion exactly that. This explains why both these stocks have suddenly come into focus. To be clear, this isn't a game changer just yet. Key issues like electric vehicle subsidies and climate-related trade barriers are still unresolved. But what this deal does offer is clarity, and in today's global market, that alone is valuable. So while the West may have sealed the deal, the ripple effect is quietly revving up India's auto game.
Hey, thank you for watching this on CNBC TV18. Hope you liked it. For more such interesting news and updates, follow CNBC TV18 on all the social media platforms.